Who's joining us here in Chicago, Alan? I think, at least you're usually in Chicago.
No,
Luckman.
back up to Michigan.
All right, there you go. You're close. You're close. You're right around the corner. Alan, if we've got cruise lines continuing to postpone their plans, virus flare-ups happening, how long can this market go before there needs to be a second assessment and a bearish move here to reflect some of these negative developments?
Well, we'll know it when we see it, but right now I haven't seen it. Last week was exactly what we needed. The snap back after the profit-taking pull-down that we saw in the marketplace. We saw 10K days every day last week except for Monday in the NASDAQ and the NDX anyways. So, those markets have come right back. As we've seen in a bull market, we're in a strong trend, and I'm just not fighting it at this point.
Okay. The NASDAQ's above 10,000 again today. Do you want to be long, Alan, or are you a fan of the idea that this market can be range-bound?
I'm still long. I still think that you can look at the Dow and the S&P stocks. They still haven't had a full V recovery, and they still have a lot more to catch up if you're going to look at them, the gains in relative terms. And oftentimes, tech has led the way over the last couple of years. So let's look for that to continue. What we saw last week was vital when we talk about the S&P. It was a test of 3,000 and a reject of that and bounce back above. So that's very, very positive once again. Let's see if we can get to that 3,200 is the next step of this range. But the way that the buyers came in, the bulls stepped up once again, is very, very positive.
Yeah. All right. Tell me what you're looking at right now. I know you like to go through and try and find stocks that have not been partaking in the rally. What is your search digging up now, Mr. Nuttman?
Well, this one's a little different. This one has already rallied, but it's pulled back off its recent highs. So oil's well. So we can talk about oil, that capitulation that we saw with that futures contract kerfuffle. That was actually a very positive sign, and oil's gone straight up since that time. So we've been seeing crude oil. If you look at the August contract, I'm not going to get into what the June contract, in theory, I guess, for some people that obviously went negative, but in my mind, that was just an aberration. But if you look at the August contract, we've been trading between 60 and 20 now for the last year. So that has a midpoint at 40. We hit 40 again last night. A push above 40 in crude oil is very much a positive. Think about it. We're at $40 when we were actually negative just 2 months ago. So Occidental Petroleum is the stock I'm looking at. This has been range bound now in a wide range between 10 and 25. So the halfway point is 17.5. I'm looking at the August 17.5 calls, and if we can make another pop, there's a gap at 25, there's a gap at 30, and then there's another gap at 40. So I'm thinking that there's more upside potential here on this pullback because this was a $50 stock at this time last year.
Yeah. All right. So basically, you're looking right now at buying some of the recent pullbacks. So you're viewing these dips that we saw in that sell-off now almost 2 weeks ago that have not fully returned. You're still seeing that as a dip that should get bought. Is it energy only specific, or are you looking at that across the board for some of the consumer names we've been talking about here?
I'm looking at it across the board, but now there are some that have had a significant recovery. Last week we talked about Cisco. Cisco pushed that near 55 level looking for a breakout. Not quite, but it held its solid 50 level. So it's the same kind of risk-reward mentality, the way to attack the markets. I'm still a believer, and you want to buy the dips. And from that standpoint, your leverage is that much better. If it doesn't follow through in the upside, at least you're not buying it after it's had a big, big rally. So that's the standpoint here. It's a very basic stock substitution strategy. If we get back to that recent 25 high in OXY, and that option will obviously have a very, very significant payoff. It'll be significantly in the money. I use in the money options instead of the stock. Ties up less money, has less risk. And for the August option, it was only $75 more than the July option. So for extra $75, why not have the time, even though I'm looking for something to happen here in the next 3 weeks?
Yeah, all right. $2 already in the money. The 1750 calls is we're at almost $20 right now. Alan, appreciate, as always, the insight into what you're looking at. Mr. Nuttman joining us from Agora Financial. When we get back, let's continue to walk through the sections of the economy that have had the most trouble. We're going to be looking at options, and we're going to be looking at sentiment, because so far that has not been enough to derail the overall bullish trend in this market. We'll also look at charts on some of the staples groups.